So the number one reason why people don't invest into real estate is because they don't think they have the capital or the equity in order to purchase it. But often there is money that is there, but it's hidden. It's just locked up. And so the problem is that most investors don't know that they have multiple options to access capital in order to buy real estate. Well, today, John and I are going to be breaking down the different options real estate investors can tap into in order to buy more real estate, because the number one regret people have when it comes to investing is they wish they would have bought more real estate. John, it's great to be here with you.
So good to be here, Mark. I'm one of those people. I've told the story before, but my income was tied up in real estate, so I didn't invest in real estate. When I look back at the 20 years I spent in residential real estate, realize all the missed opportunities, right? So I'm all in. In fact, some of these strategies we're going to be talking about is one of them I'm utilizing personally myself. So really excited to dive into this topic today.
For sure. And now, John, this is something that's really important to talk about is that through the years of helping thousands of investors buy real estate, one of the biggest things that we did it was to be able to reach out to a client and they weren't even thinking about buying real estate or another property. They had lots of equity in their home and they weren't even thinking about it. But what we would do is we'd reach out and say, "Hey, have you ever thought about buying an investment property? Here's what the typical returns could look like. Here's what it would look like." And we basically rolled out the red carpet for them. And we basically helped them tap into these hidden sources of equity in order to buy real estate. And a lot of our investors, they made hundreds of thousands, even millions of dollars through the years by using the approaches that we're going to be talking about today. So if you really tune in and then you take action from some of the things that we're going to be going over with you, it's going to be a short episode today. It really will help you take it to the next level and build your wealth a lot faster.
That's right. I mean, at the end of the day, these tools are available to basically just about anybody, right? It depends on which kind of option or approach we're talking about. But all of our investors generally own a personal property, right? They have investment dollars that they've invested. So these are kind of some creative ways. And what's really cool for me, Mark, is actually I was inspired by one of our investors in our first deal, Largo, because they took one of these approaches. And I was like, I never thought about that, right? So we're learning all the time, and these are some approaches that everybody should at least have in their knowledge base. So if they find a great deal and maybe their capital's locked up, they can potentially utilize one of these so they didn't miss out on an incredible opportunity. So, the first one, Mark, is going back to what I just mentioned, right? Just about every one of our investors owns their personal home. And if you've owned your home for a while and you built up some really great equity in it, that equity is effectively locked up right now. Your property value continues to go up as the property appreciation in your area occurs. But the money is just sitting there. In fact, when I sold my company a few years ago, Mark, my financial planner looked at me like I was crazy when I said I wanted to pay my home off, because she's like, "Gosh, John, you got a low interest rate. You can invest that money and get more." But for me, just personally, I like the idea of not owing anybody any money on my personal property. But my home's value has more than doubled since I bought it. So getting a home equity line of credit is an option that is available to me and largely to a lot of our investors. So basically, you're allowed to tap into that home equity, often at about 75 to 85% loan to value. And what's great about HELOC loans is they're generally interest only and often low interest and flexible terms. So you basically can get the home equity line of credit, that HELOC, and not utilize it, right? It's there. It's almost like a checkbook. You can write that check when you need it, and then you start paying interest at that time. So it's a very flexible way for some high income investor with a lot of home equity to basically use some of that equity in their home for
Mm.
liquidity for new investments. So for example, say for, you want to put $100,000 into one of Faris Capital Partners deals, you pull that out. Now, interest rates are varying, right? But let's just say you get a 5 to 6% interest rate. And our deals are typically throwing off on average 6+% in monthly or annual cash flow, right? So when those cash flow checks come in, you can just pay down the interest as that comes through and then get all the upside when we exit the deal. So home equity line of credit is number one and one of the great options investors can consider.
For sure. And a lot of investors don't even know that they can tap into that. And that's actually it's a really great option to be able to pull some funds out and invest it. And so not only that, the home equity line of credit is just good to have as an emergency fund. And there's a couple of things for that. So if you never know if you need it, but what the problem with most banks and lenders are is that when you need them, they don't want to give you money. When you don't need them, they want to give you all the money in the world, right? They want to
Right.
like, here, take it. Yeah, you're good. But when you don't need it is generally when they're doing that. But when you do need it, they're we'll say a little bit more stringent. And so we're seeing that in today's market where banks are starting to tightening up. And now is a time where more and more people need access to extra funds. So just by getting a home equity line of credit, even if you don't invest in more real estate, just having it there as a backup ready to go, you don't get charged interest unless you use the funds, but is there for you as a backup. Now, another reason why home equity line of credit is really smart, I was speaking with my lawyer and he said, listen, there's a lot of people that own homes free and clear. But he said one of the problems with that is you are at more risk than if you than somebody that has a line of credit, even if they don't have they're not even utilizing it. So what it does is it creates an extra threshold of security because if somebody wanted to impersonate you and go to the bank and basically it's mortgage fraud, they go to the bank and they do a refi and they pull the funds out and they give a different wiring instructions to send the funds through. They can impersonate you and actually put a mortgage on your place without you even knowing it. Now, if you have a home equity line of credit, let's just say you own a property free and clear for $1 million and you get a home equity line of credit for whatever it is, 100,000, 50,000, 500,000. The point there is that that's in first position there with the lender. And if there's anybody that needs to impersonate, that's going to impersonate you and try to pull funds out. Well, that has a lock for the first, that 500,000 that you have as a home equity line of credit, and it's an extra protection barrier for you. So this is one of the things that my lawyer said, hey, listen, all your clients recommend that they get this home equity line of credit not only for emergency funds, but for extra security for you because there is a lot of mortgage fraud going on out there.
That is such an interesting example, Mark. I hadn't actually thought of that one, but now you've got me thinking. Maybe I should have that just in place. And it's that's a really great example. Wow. Kind of alongside that, but a little bit different, is a security-backed line of credit, right? So, if you have investment accounts that you are investing dollars in, now these aren't your retirement investment accounts, right? So it'd just be your general brokerage account. For example, I'm with Edward Jones down here in the United States, and right on my statement, there was a line saying, this is what is available in terms of credit. Here's what your interest rate is. And so I reached out to my financial planner, and that's how I'm now investing in real estate deals. So my money's still working for me. And, of course, the stock market can go up and it can go down, but I'm generally getting 8 to 10% returns in a given year. That's been pretty good over the last few, some years down, some years up, but on average about 8 to 10%. And so right now I'm offered an interest rate of 5.5%. Rates are higher right now, but I could take out some money, invest it in these real estate deals. That investment money still sitting there working for me. I'm just paying interest on the difference that I borrowed. And so once again, the cash flow that these deals are generating are paying down that interest, and I get all the upside when we exit the deal. So that's a great option if you either already have a HELOC and maybe have spent some money, maybe you renovated your basement or something like that, and that money's already spoken for. This is another option or opportunity for you. So generally, if you have over $250,000 in a brokerage account, these lines of credits are available to you. Every bank's different. Every investment bank's different. You'll need to reach out and inquire, but it's another option very similar to the HELOC with similar terms. You're not charged the interest, in other words, until you utilize it, but a way to keep your dollars working for you in the market while also getting the great returns that these real estate deals can afford.
For sure. And there's little subtleties, whether side of the border you're on, if you're on the
Yeah.
Canadian side or on the American side. So definitely look at as we're going over, we'll consider both sides. The next one is on the US side, this thing called self-directed IRA or Roth IRA. So that's very similar to a RRSP or a TFSA on the Canadian side. Basically, the registered funds that you're able to invest in lower your taxable income. And so the cool news here is on the Canadian side is coming into 2026, we are setting it up that you can actually tap into these registered funds. A lot of times they're not doing very well. You're like, I'm making like 5% or I'm kind of even right now, but they haven't really done anything for me over the years. I've had many, many, many conversations with investors. And so we are setting our structure up to be able to allow you to tap into these registered funds. Now, on the US side, John, maybe you could talk a little bit more about that. That we do have that in place where you can tap into that in today's market right now. But these are another way that we can you can get access to funds that you didn't think were available in order to invest into more real estate.
That's right. So on the US side, if you have a Roth IRA or a self directed IRA, you are able to invest in real estate using those funds. Now, you can't just withdraw funds and go invest in real estate. You have to work with a third party registered IRA custodian. We actually have referrals. So if you're listening to this and you're like, who do I talk to? We can help you find a couple of different companies that offer this service. But basically, they do an analysis, make sure you're not doing something foolish or putting your money somewhere it shouldn't be. But that's kind of the purpose of these third parties. They go in, they run it. You can invest in syndications like what we do at Faris Capital Partner, or you can go buy a piece of rental property. Really, other options as well. But we're going to focus on real estate. So with a Roth IRA, if you're listening to this in the U.S., you probably already know this, but you basically have tax-free growth, right? So the dollars you put in today are taxed today, but the gains when you withdraw at 65 are not taxed. So if you have a Roth IRA, it's an awesome way to grow your equity in a very meaningful way. Because as you pointed out, Mark, sometimes you're just either investing in stocks or mutual funds, and you're getting like okay or sort of like subpar returns. But we know the returns that real estate can afford. So as you're building out your retirement, knowing that that will be tax free when you withdraw at 65, like what better way to build that than through real estate? Your more traditional self-directed IRAs, you don't pay taxes today. You take the tax when you withdraw. So you fund your IRA today. You avoid the taxes on that income that you invest today, but you do get taxed at the end. Both are great options, but of course the Roth just has that benefit of not
Mm.
being taxable when you withdraw. So it just goes back to, working with these third party intermediaries. So if you're thinking about this approach, make sure you talk to somebody who understands this stuff or reach out to us so we can help direct you.
For sure. Number four is whole life insurance. So this is a really smart way to be able to use an insurance company to basically get a loan. So what happens is you can buy into this whole life insurance. So say you put $100,000 down, you can actually go to a lender with that whole life insurance policy and say, hey, listen, I have this security of this whole life insurance, which means that I'm going to get paid out when I pass away, and the lenders, the banks will actually utilize that as collateral, and they'll say they'll recognize that. So then you can actually go to the lender, and this works on both sides of the border, and say, hey, listen, we have this collateral, can you loan me money? And so not only at that on that $100,000 are you getting interest for the investment that you made into that life insurance policy, but now you can actually go to, so you're getting interest like 5 or 6% on the insurance policy they're paying you, and then you go to the lender and say, hey, listen, take this collateral, I'd like to get a loan, and then you're going to pay them 5 to 6% for that loan, and then you take that $100,000 loan and you can go and invest into real estate. So we call this investing the money twice, like utilizing the money twice. So not only do you get this big we'll say coverage, if something were to happen to you, you would be covered for many, many dollars, but you're also have that original $100,000 that you're actually getting a really strong return on it. And it's just a really great overall strategy that we'll just say the high net worth individuals, they're all doing it.
That's right. And then lastly, this is actually sort of a catch-all. There's a few kind of tips within this fifth one, but maybe at the end of the year you're expecting a big bonus coming. Another factor could be maybe you have some restricted stock units. So you work for a startup and you've been gifted stock as part of your compensation package, but that stock is locked up today. You can often borrow against that because if the value of the stock continues to rise, and it's no different than the securities-backed line of credit, but that's an approach. Or you can even refinance maybe a current investment property. So maybe you bought a rental property 7, 8 years ago. It's performed well. You've got some great appreciation and some forced appreciation. Perhaps you did some renovations and drove the rent up. you can go back to your bank, refinance, pull some of that equity out and invest it into the next deal, right? And similarly, you'll be paying some, you refinance, right? So your loan structure will change on that original, but if your rents have gone up, it supports that payment. Now you can pull some equity out of that rental property and invest it in the next deal. So just as a final thought here, you can kind of start stacking these things together, right? So maybe you
Mm.
refinance a rental property and then you come over here and you take a little bit out of your HELOC, and now you have that minimum $100,000 investment. Now, some key considerations you have to think through, right, is understanding the risk reward payoff, right? So in other words, if you're taking money out of your personal property or you're taking money and borrowing against your securities, obviously if it's a bad investment, you will owe that money back plus interest, right? So this is not something you do just like, oh, quick, I'll make a fast decision on. Do your due diligence, do your research, understand the risk and the reward that are offered in these investments. Really be clear on your interest rate. Is that interest rate fixed? Could it change? What happens if rates go up and it's a floating rate, right? So these are very thoughtful things you have to go through. You have to really consider all of these. And is there a repayment term that I need to be aware of? Is it like 3 years? Is there a balloon payment or something like that? So get real clear on those repayment terms and your interest rate. And, basically my suggestion would be only use leverage to buy cash flowing assets, right?
Yeah,
Not
big one.
speculation plays, right?
Yeah,
So when that interest is coming in, you have to pay it, but now you've got cash flow coming in that helps
yeah.
offset that interest, right? That's where this really works. You would not want to invest in something that's not going to pay off for 3 or 4 years. To me, that would be too much risk. I simply wouldn't do it. You may have a higher risk tolerance than I do, but for me, I would not recommend that. And make sure that that investment's cash flow can comfortably cover your loan payments if needed, right? And that's kind of what we've talked about. If the interest rate is lower than the potential cash flow, that's when you should be paying attention and thinking about one of these strategies.
And so, yeah, if you have any questions about this, you can click on the link below and actually book a one-on-one call with John or myself. And you can actually learn more about our investments. Go to fulloutinvesting.com and you'll be able to see our 10-step full out investing process. And there's a sample deal there as well. Thanks for listening to the show, guys. And if you liked it, please share with other high net worth investors that are considering investing into real estate. We love and believe in you guys. Keep dreaming big.